If you are still confused about debit and credit, so stay here. In this video, I will make it simple and I will explain two methods for the double entry and clear some misconception regarding debit and credit. What is double entry? First, the double entry is a foundation of accounting and bookkeeping process. It actually says that every transaction affects two accounts with the same amount, just debit and credit. Pretend it as a two side of a coin with same amount, two sides, heads and tails. And in accounting, you have debit and credit with the same amount. So double entry actually ensures that accounting equation stays balanced. How? Basic accounting equation is assets equal to capital plus liabilities. Assets increase with debit and liability increase with credit. So capital is a bit tricky one. So let's expand it. Capital section is consisted of owner's equity less dividends plus revenue less expenses. If you rearrange the equation, you will have for the left side dividends plus expenses plus assets, which all of the three increase with debit. And for the right side, you will have revenue plus owner's equity plus liabilities, and all of the three increase with credit. So right here, you will have three debits with the left side and three credits for the right side. In order to remember easily, use the keyword dealer. So D actually stands for dividends, E for expenses, and A for assets, while L for liabilities, E for equity or A capital, and R for revenue or income. Why do we need double entry? Double entry ensures that the books are always balanced and the total side of debits equals to the total side of credits and trial balance. Next, this is a systematic approach to eliminate guesswork and errors. Lastly, it helps us shows a complete picture of performance of a business over a period. There are some misconceptions about debits and credits. Most of the people think that debit is a bad or a good thing and credit is a bad thing for the business. So this is not the case. This is just a misconception. And for the first method, you will need to have those six elements of accounting. Assets, what the business owns; liabilities, what the business owes to others; capital, the owner's investment in a business; income, revenue earned; and expenses, cost incurred. Lastly, dividends or drawings is the money taken out by the owners and actually reduces the equity. For the first method, you will need to learn the nature of those six elements. So right here, three of the elements, which is consisted of assets, expenses, and dividends, increase with debit and decrease with credit. And other three remainings, liabilities, capital, and income, increase with credit and decrease with debit. The second method, which is absolutely easy to implement in double entry and bookkeeping process, is the destination and source method. We all know that in a business transaction, the money does not disappear. It actually goes from source towards the destination. So keep in mind that destination is always a debit and source is always a credit. In those examples, I will implement both of the methods and shows how it works. First example, a person started a business with cash 1000. So first method, cash account is an asset account. Whenever it increases, it's a debit. And the next account is capital account. And whenever it increases, it's a credit. So the second method, source and destination. The destination right here is cash account and it should be debited with 1000, and the source account is capital account, which should be credited with 1000. And second example, a company bought furniture for cash 200. So the destination right here is furniture account, which should be debited with 200, and the source account is cash account, which should be credited with 200. Third example, a company received income for 300. So destination right here, cash account, which should be debited, and the source account is income account, which should be credited with 300. Fourth example, a company paid rent for 100. The destination right here is rent expense and debited, and the cash account is source account, it should be credited with 100.